Hello, my name is David and welcome to David Computes. Today we'll be looking at some SP 500 data. We have a time series with daily data from the Standard & Poor's 500. And as we've done in previous videos where we calculate for some very simple statistics, as you can see already on the top, the counts, which tells us how many days are in this time series, since it's a daily time series. An average, a medium, it counts how many days had the gain, so 997 for this specific example. In percentage, it corresponds to 54.27%. And then how many days had a loss or were down for the day, that was 840 days. And then again the same thing in percentage was 73% of the days were down. Then we had also the maximum and the minimum gain and loss. So on this video I thought we could explore this information a bit more in detail. So for instance, we could look into this detailed in terms of the day of the week. So you could think, okay, so if I only look at Mondays, how many up days are generally on Mondays or Tuesdays and so forth? And the same thing, we could look at, what's the number of days that were down on Mondays. Will there be any interesting information that we can gather from that analysis? Likewise, we can calculate the averages and minimums for each day of the week, and again maximum minimums. Again, in the similar work we've done in previous videos, but in this case looking specifically at the days of the week, what's common use seasonality. Then additionally, we could do not only based on days of the week, we could do it by month. We could do this work about what happens on Januaries over a stretch of several years, or Februaries or March. So there's several ways. I'll start with the days of the week and see what we can find from here. So to start with, let's just calculate in which day of the week each one of these days fall over. So we'll use the weekday function. So that's a 2 will be a Monday, 3 will be a Tuesday, 4th a Wednesday, and so forth. So let's have this data for everyone. So now we know which day of the week, and let's break this down by each one of days of the week. So let's say if we have Monday, Tuesday, Wednesday, Thursday, and Friday. So this being the Standard & Poor's, obviously it only trades from Monday to Friday. If we were to use a different time series, for example, if we look at futures, some of the futures can start trading on Sunday evenings, so we would have to calculate this differently. But for this example will suffice. So let's then break this down. So I'm going to filter basically only the Mondays, and if that's the case, let's put the value of gain or loss in the cell. Otherwise, we're going to say no. So we're going to fill in, and we're only going to capture the Monday. So what I put here is a simple if expression. It says if the value in H7, which is the weekday, equals the value in I6, which is Mondays, that's a number 2, but it's equivalent to Mondays, then copy the value that I have in column G, which is our gain or loss. And we will do a similar thing. Let me lock that column there, which is the $sign. We'll lock the value. And let's calculate this for the remaining days of the week. So now we have all the data broken down by days of the week, and for sake of simplicity, let's just put some labels here. And let's see what we can take from this. Okay, there you go. So we can start doing some very simple statistics on this. Let's create some spaces here. Add some more space so we can start adding some statistics. So let's start with the count. You know, how many days fell on a Monday. So we'll just put some simple label here so we know what we're doing. Let's do that identification. So our last row stands at 1,852. So we have 345 days that fell on a Monday. Let's just remove those decimal units. We don't need it in this case. And let's do the same for the rest of the... And of course, if we were to sum this, will give us our total number, 1,837, which is right. So we know that it's right and nothing, we haven't lost anything while we're doing this calculation. Okay, so now we can, for instance, calculate the average for each day of the week. In fact, it's just simpler. Okay. What's the number of decimal houses? Possibly just keep 3 should be enough. And correct this. And there you go. So we can see now the average, the value for value for each day of the week. So we can see some interesting information coming from this, that one would expect that the average would be more or less the same for each day of the week, but at first glance at least it seems that the values vary quite a bit. So Mondays, Wednesdays, Thursdays and Fridays seem to be always the average seems to be positive, but on Tuesday seems to be slightly negative. But let's not let's do a bit more analysis on this and see what else can we see from this data set. Let's calculate the average. Let's calculate the sum. So let's calculate what's the total gain for each day of the week. Instead of just typing everything, I'll just use the value above, retype the formula. And there you go. So 5.74% gain. If one, okay, so what does this mean? If one was to open a position or just add the gain just on the Monday and close it at the end of the Monday and repeat this for every single Monday, after this set of data, so after 1,833 days, in this case after 345 Mondays, we would actually have a gain of 5.74%. And interestingly enough, the gains for Tuesdays is negative. We would be losing 1.8% if we were only to consider the Standard & Poor's data for Tuesdays. And again, look how this value is quite different for the Wednesday, the Thursday, and the Friday. It's quite a different value. So there seems to be a bit of seasonality again at first glance. Let's get some more values here. Let's get, for instance, the maximum. Let's get the minimum value for each one of these days of the week and see what else do we find, see if there's any more surprises. And the same thing for the minimum. And see what the data tells us. So as you can see, again, perhaps not much information can be taken out of the maximum and the minimum. They are quite outside your typical values, so the extreme days where you've seen very large gains or very large losses. But this still stands out, and let's do actually put this on bold so we don't forget it. So this still stands out. And of course, what we should do, just as a benchmark, is we should see what is the some if we were to track the Standard & Poor's 500 every single day of the week. So that's very easy to do as well. So let's do that so we can have something to compare it, a benchmark, so to say. So if we were basically following the Standard & Poor's every day of the week, we would actually be looking at a gain of 38.48%. So this from the 8th of April 2014 all the way to 23rd of July 2021. So this is just a sample of data. I didn't choose this sample data for any particular meaning. It was just a considerable amount of data that I've selected and got into this spreadsheet so that we can go through this video. It doesn't have extra meaning to it. It's just to allow us to do some work. So although we do see these values, these very different values in terms of seasonality, it's still any of them are beneath the benchmark. So we would still have been better to just basically follow the Standard & Poor's every day of the week. So if you were to trade, basically what it's saying is if you buy and hold throughout, you'd be better off in this case, because we're not taking into account the trading outside of the market hours. It means basically every day you buy and then you'd sell, and next day you buy, you sell again. And assuming there was no commissions or slippage, you would be looking at this percentage of gain. If you were to repeat the same thing, but only on Mondays, only on Tuesdays, this is what you would expect. So much smaller values, and on Tuesday you would actually be losing money. But of course, don't forget there's a factor into all this, is the fact that you are out of the market the other 4 days of the week. In this example, you're actually exposed to less risk. You were actually, because if you're in the market, you're exposed to risk. But I digress, that's not the objective of this discussion. What other conclusions can we perhaps take out of this data? For instance, that just on Wednesdays seems to be where almost half the gains, slightly below half of the gains were made. So were we only to trade on Wednesdays, we would be making half of the gains for the entire data set. Now, let's also calculate the number of days that were positive and the number of days that were negative, and see if there's any extra information as well that we can take from there. So let's make some space here. Let's put 4 rows free, so to count the positives and the negatives, and then the same thing for in percentage. Let's see what information can we see. So let's just count positives. So we'll use the count if function. So count if the value is greater than 0. Let's correct the range of this data. And we can see that 188 days for considering only Mondays were up days. Let's do the same thing for the other days of the week. And if we were to do the same thing, but this time express it in terms of a percentage, and we can see that 54.49, rounding down, of the days were positive. And the other thing that immediately strikes out is that although we know that Tuesdays added all together were actually represented a small loss, it's interesting to see that the percentage of up days were it's not very different compared to other days of the week, which might just tell us that this discrepancy in the data, it might be due to just a very few days. There was just a few Tuesdays that were outliers and brought this value down. But let's not take this conclusion just now, but we have a suspicion. So let's check the same thing for negative days. So we want, in this case, the negative value. Obviously, if we could have subtracted 345 minus 100, would have given this, or you can just calculate it again. Both of them would have served us equally well. So the same with the percentage, we can calculate it again, or just subtract it from 100. So, okay, let's have the percentage values for the remaining and perhaps reduce the number of decimal houses here. It's a bit unnecessary, so many units. Okay, so does anything stand out? Not particularly. The Tuesday is still a bit of an outlier here, the Tuesdays. I'm making this recording after producing this video. I just wanted to make one small note that I thought was worth doing. I was just mentioning how the Tuesday is a bit of an outlier with a negative value for all the Tuesdays. But in doing so, forgot to mention again, and it's worth mentioning, the very high value for Wednesday. I mean, almost half the gain is mentioned before. So that's, of course, is an outlier. I just forgot to mention here. And the same could even be mentioned in a way for Thursdays as well. So just these 2 days together represent altogether 29% of the total gains. I mean, that's well more than 2/3. So if you would just stay in the market on Wednesdays and Thursdays, you will be making the most of the gains for this particular data set. And I'm not trying to read too much into it, but it is worth mentioning that that note that the outlier is just not Tuesday, because it's actually a loss on Tuesdays, but the fact that Wednesdays and Thursdays together, they make the majority, the bulk. So that's an outlier as well. So we could look into this in more detail, see if there's actually an edge, if there's actually a bias here for this. I'll leave at that, and it was just a note I wanted to present. But we've spoken about some of the conclusions we could have taken out of the data by just looking at this. Now, I mentioned in the beginning of this video that we could do similar work for the months of the year and take a similar conclusion. So, for instance, let's just very quickly do this for the month. So, if we're to calculate the month there, and just have let's just put a label here. And then we'll break it down the same way we've done before. October, November, December. So we'll just do the same as we've done before. So if it's April and equals that, then put the gain or loss otherwise. And we'll lock down again. And lock this as well. Now we can calculate for all of them. So just very quickly, we populate the rest of the cells. Just double click on the corner, you get everything populated all the way to the last row of this column, to the last row that contains data. So now there we go, we have the data there. And as we did similarly, we did with the weekdays, we could do the same for the month, and we don't have to, we can just copy paste the formula and get it done there. So we just extend it to include the rest of the days, and there we go. So okay. Oh, because there's a typo here on this formula. I forgot to lock down the 15 here. So 015. No, I did. So why is it not? I was before. So there you go. So there we go. We have the data there. Again, is there anything that stands out looking at these? If in the same reasoning we've done for the weekdays, what would happen if we were track down the Standard & Poor's 500 only for the Januaries? So there was 141 days that fell in Januaries. and the sum is 2.8%. So if we did every single day, but only in January, during the month of January, what would be the results? And again, there's a few things that stand out here, namely that September, October, and December were actually negative compared to all the other days. We can look at possible explanations for this, but it's interesting to know that the data is showing you this. What else can we see? The number of days is more or less, for this amount of data, is more or less similar to each other. There's no big outliers, because I tried more or less to... No, actually, although it's data from April to July, it's not really from month to month, but not that much variation. Okay, I'll be ending the video here. I tried not to make these too long and stay between 12 to 20 minutes. But the principle that we applied here could be applied for other types of seasonalities if you wanted to do on a year-by-year basis. The other thing we can do, perhaps we can go through that on a separate video, is to do the seasonality by day of the week and by month, but break it down per year. So only do the Mondays on a given year, the Tuesdays on a given year, and then calculate it for each separate year, so you can check if the Mondays behave more or less the same on a year-by-year basis, because obviously here we have several years worth of data, so the Mondays you cannot take any conclusions just comparing Mondays from different years. And similar reasoning for the months. We have several Januaries here from 2014, well, 2014 no, but for 2015 to 2021, and of course we cannot compare how the Januaries behave from year to year. But for instance, if you have a data set that goes through many years, you could do a seasonality study where you break the Januaries for each one of the year, compare. So for instance, let's say, just as a quick example, we can see here that September as a loss for the data set we did. So it would be interesting, for instance, to see, are all Septembers like this? So what we would done is we would calculate the data for September, let's say 2010, then September 2011, and so forth until up to now, for example, but a considerable amount of data, not just one or two, because you couldn't take any conclusions for that. And even for this small amount of data, there's only so many conclusions you can take. You shouldn't read too much for this if your data set, if your universe of data is very small. But let's say you do like 10 years worth of data from 2010 to 2020, and let's say that all Septembers in the best case scenarios are negative. So what that would say is that it appears that there is an edge, there is a bias that September's to be negative. And again, if you did the same thing for Octobers, or on the other extreme, what could happen is that all Septembers were positive and there was one September, one outlier in one of the years that was very negative, more than the average value, and therefore the sum would bring this value down. And again, as you do this reasoning for negative values, you could do the same for positives. For instance, why is November such a high number, like 68% of the values, pardon, not 68, 16.56% rounded down are positive. And you can carry on like this and try to figure out, if there's anything that catches your attention, and if you could use that to your benefit for your investments, for your trading, or just for your own education. If there's something that you could read into that. There's already a lot of seasonality studies done out there, and for instance, a lot of people point out that September and October tend to be months of higher volatility and tend to be negative days. For instance, October has an history of market downturns, and I won't go over that. Perhaps again a subject for another video. I don't want to read too much into it. I just wanted to show how you can quickly do this type of studies in a spreadsheet without having to know much. You don't have to do coding. We don't have to do anything too sophisticated, but in a spreadsheet very quickly you can glean a lot of things from this data. So the other thing I wanted to say is, if you want if you have any questions do you want to do regarding this video or any other aspects regarding to Excel or to the data, feel free to do so, either leaving a comment beneath or dropping me an email. You can get that on the contact of the channel. And if you have any requests, again, do so. Thank you for watching all the way. I hope you enjoyed it. I hope you find this interesting. I hope you find this inspiring, and hope to see you again. Thank you very much.